Welcome back to the Gold News channel, a slightly different Gold News channel today because we have a little bit of a live audience, some wonderful ladies here on the Gold Coast who are very keen to hear about my recent trip to the Rural Investment Symposium in Boca Raton, Florida. And so they've come to hear about my experience. And then I reached out to Rick. Well, in fact, I was talking to Rick's wife, Bonnie, who put Rick in the driving seat and said, well, Rick would love to have a chat with him. So Rick, thank you so much for your time. I know it's evening over there, and we really appreciate it. One of the things that you said right at the start of your conference in Florida was take notes.
Right.
And you said to everybody, you don't remember after you leave a conference all of the information that you took down. So I would like to say to you, thank you very much. This is a full book of notes, which I have reread.
I'm delighted. Part of life, in any aspect of life, including as an investor, is to outcompete your peers. And the way you outcompete your peers is to work harder than them and work more efficiently than them. I've noticed in my life that even though I believe I'm going to remember something at the time that I hear it, 10 minutes later, there's something that crowds that out of my mind. And to the extent that I take notes, my memory is enhanced. To the extent, too, which I also ask people at the conference to do, and I would ask attendees at your conference to do, during a conference when information is coming to you in such a fast and furious fashion, at the end of the conference, before cocktail hour, go upstairs, review the notes, collate the notes, and figure out what part of the day's activities were important to you. If you, very much like if you buy a book but don't read it,
Yeah,
that book is of limited utility. If you take notes but don't review them, if you don't use the notes to refresh your memory, and in particular, refresh your memory with the anticipation of those notes stimulating action, you may as well not have taken the notes, and you may as well not have gone to the conference. You could just stay home and drink and have fun with your girlfriends.
yeah, yeah. I do, I 100% agree. I have re-looked at my notes, but probably need to go and do it again, Rick. But what was, I found the conference very interesting. You had some incredibly good keynote speakers, which I will talk to the girls about later. But one of the things that they are looking to do is, what do you think? What does Rick Rule think about the current investment market? It is very volatile. We are sitting in high inflationary times. Mainstream media doesn't tell us the truth. You and I both know that. What does Rick Rule feel about the current investment market?
Well, for me, it's excellent. People are terrified.
Yeah.
Which means that assets that I'd like to own are becoming cheaper. That's great. I think that most people that invest, most people that go to most conferences, pay slavish attention to the price of assets, which is a floating abstraction, and they pay no attention to value. What use is price information if you can't ascertain, to some degree, the delta between price and value? Someone in Sydney might say to me, XYZ Resources is selling for $2 a share. Is that good or bad? I ask them what they think XYZ is worth, and they say, oh, I don't know, the bid or the ask. Well, that's very wrong. That's the price, it's not the value.
Yeah.
Warren Buffett famously says that the market in the near term is a voting machine. In the longer term, it's a weighing machine. If you're comfortable with the way people vote, perhaps normal markets make sense to you. But money is made on the delta between price and value, the difference between the way people vote, which is based on narrative, and what assets weigh or what they're worth. And I think we did a good job at the conference this year in explaining that dichotomy to investors in a way they understood, asking them to pay less attention to price and more attention to the delta, the difference between price and value. If, Carrie, let's say that you decide that a stock is worth $1. If the stock is selling for $2, it's probably not a good buy. Let's say that you bought the stock at $1, and let's say that nothing changed. with the underlying fundamentals of the stock. But due to promotion or the market or whatever, the stock went to $2. At $2, the price relative to the value is precisely half as attractive.
Yeah.
People like the fact that the price went from $1 to $2, and human reaction, because it gave them pleasure, is often to buy more. But the fact is, if the price doubles with no underlying change in the valuation, the stock is less attractive. Similarly, if you think the stock is worth $1 and it falls to 50 cents, many people, if the stock falls from $1 to 50 cents, pay no attention to value and they sell the stock because it went down.
Yeah.
But if the stock goes from $1 to 50 cents, it's precisely it's precisely 100% more attractive. Interestingly, and I'm pandering to my audience now, being all female, when I discuss this circumstance in the context of a sale, which is to say you've had your eye on a winter coat, and suddenly, for whatever reason, the merchant marks it down from $400 to $200, it doesn't become less attractive. It becomes twice as attractive. And if more people would buy stocks the way women buy coats, the world would be a richer place.
Everybody here just nodded their heads and said, absolutely. That was a very good analogy for the current audience.
Gary, I'm 70 years of age. I know how to pander to an audience, okay?
I want to know where the jacket is.
Someone just said that they want to know where the jacket is. Now, please
Where's
chime
the
in
money?
if you've got a specific question.
Okay.
Please chime in and
Thank
just
you.
say, this is what how do we do this? So when you just mentioned price and value, Rick, when you look at value, how do you value a stock other than, looking at the quarterlies, looking at what especially for an exploration in mining? I mean, how do you value something like that?
That's a very long question, Carrie, and probably we need to do it pre-wine, and we probably need to take an hour to do it.
Mm.
I construct a variety of net present value models, which
Okay.
is to say I look at the available documentation and I try and establish as best I can a resource estimate. I try and establish what the capital costs will be. I try and establish what the operating costs will be. I tend to use the forward strip in commodity pricing because I'm not smart enough to know where commodity prices are going to go most of the time. And I do a net present value calculation. My net present value calculation varies from country to country, depending on that country's sovereign cost of funds in US dollars in a 10-year instrument with a 300 basis point premium. So as an example, if I'm buying an exploration company based in Mali, where their US dollar cost of funds is 12%, I use a 15% discount.
Got it.
If I'm buying a company based in Australia, where their 10-year cost of funds in US dollars is 4.5% or 5%, I use an 8% discount. Now, I know there are flaws with that model, Carrie, but my model is better than most people's because most people don't have a model at all.
Exactly. Yeah.
What I found in 50 years of doing this stuff is that the search for perfection is a form of procrastination. You have to give yourself a matrix of values, and you have to be able to assign some relative probability of values with the understanding that you're never going to be right. You're just going to be more right than the competition. And by the way, you're going to be more right than the brokers, whose model has a goal of trying to sell you the stock.
And I think that's a very good point, Rick, that people don't really fully understand, which is the brokers are there to sell you stock and make commission.
Sure.
They're not necessarily selling you something that they believe has, as you said before, value.
Carrie, for 40 years, I was one. If I ever wanted to get my wife to just peel with laughter, I'd say, on my honor as a stockbroker. And,
but now you're independent.
I am retired, in effect.
Yeah, well, retired, but still reaching out and helping others. And I think that's one of the things that we love about you, Rick, is that, you're so-called retired, but you really like to help people and help them understand the best way to invest.
I do, Carrie. My brain doesn't do well in neutral. My brain either likes to be engaged or numbed. So I either work or I drink. And I found that although both are very pleasant, working is better for me.
So in terms of that at the moment, we've got some people here that are looking at what's going on in the marketplace. Rick, you've loved gold over the years. We know that. I know that you're very fond of uranium as well. In these current market conditions, a little bit chaotic out there, what is Rick Rule potentially looking at the moment?
Well, certainly if you're a
Value.
speculator, I think uranium is the price to be. The stuff still sells at a discount to the global total cost of production. The mining industry would have you believe that the cost of production is, AISC, right? Mine cost, basically. But that's wrong. The total cost of production includes the cost of capital, which companies don't want to talk about. It includes social rent, which is to say taxes, fees, and royalties that the government takes. And importantly, it includes prior year write-downs on unsuccessful efforts, because those unsuccessful efforts generated the successful efforts that make the money. If you look at the total cost to produce a pound of uranium worldwide, it's about $60 US.
Yeah.
So the industry makes the stuff for 60 and they sell it for 50. They lose $10 a pound, and being miners, they try and make it up on volume, which is obviously problematic. The numbers get stranger yet if you consider the fact that there's at least a 45 million pound production deficit currently. And that means that you don't merely need to sustain existing production, you need to bring new production online. The incentive price for new production, given inflation in capital cost budgets, skilled labor, steel, cement, energy, is about 75 US dollars a pound. So the pounds that we're producing now and selling for 50, we're going to have to replace with pounds that cost us 75. Those are interesting statistics. The more interesting statistics, I guess, is despite the fact that the big thinkers, including some in Australia, don't like nuclear power. In countries even like the United States, which believe that they're rich enough to be stupid, nuclear power generates 20% of baseload and 13% of total consumption. As my former friends in the state of California learned today, a 3% plurality of supply relative to demand. That is, if you have a 3% surplus in the grid, you have brownouts and blackouts.
Is that what happened?
So, yeah, the arithmetic around this, Carrie, is within the 5 or 6 year time frame. If the uranium price doesn't go up to the level that allows the industry to earn its cost of capital, the lights go out.
Right.
It's just that simple.
Yeah.
So I would ask the ladies present, after perhaps one more glass of wine, whether they believed it more likely that the price of uranium would go up from 52 US dollars to 75, or the lights go out, because those are the only two choices. There are no other choices. Will it happen this year? I don't know. I don't know. Does it matter? The last uranium bull market that I participated in, at the beginning of that bull market, there were 5 uranium juniors.
Oh, yes.
The worst of those companies in the ensuing bull market, the worst, went up 22 times.
Goodness.
22 times. This bull market won't be aggressive as that, but it doesn't need to. It just plain doesn't need to. So for speculators, particularly speculators who can stomach volatility, and speculators who can stand their girlfriends saying to them at cocktail parties, how can you invest in Hiroshima and Nagasaki and Chernobyl and 3 Mile Island? What you'll find, Carrie, is after the bull market gets going in earnest, those self-righteous people will be asking you for stock tips in the uranium business. I guarantee it.
Wow.
I absolutely guarantee it. So for speculators, I think you need to continue to be in the uranium space. For income investors, it's a no-brainer. You want to be in the oil and gas space.
Wow. Okay.
The companies are generating massive free cash flows. They're afraid to reinvest them because governments around the world, including in your country, are saying we're going to put you out of business in 6 years.
Yeah.
I mean, the politicians are manic depressives. These morons are saying you have to produce more now because energy prices are high, but 6 years from now, we're going to steal all your investments. So, the oil companies are looking at this saying, yeah, I get it. And they're returning massive amounts of capital to shareholders. That does two things. It rewards you now as opposed to later, but it also keeps them from making sustaining capital investments, which will keep production low and keep prices high.
Good, very good point.
It's odd that the moron that runs my country and the moron that runs Canada and the moron that used to run Germany, all people who are anti-oil, have done things that inure tremendously to the benefit of oil investors. In your country, the new BHP Woodside, as an example, will be a global top 20 oil producer. It is generating something like 35% free cash margins, plenty to pay an attractive dividend, buy back shares, return capital to shareholders, while at the same time maximizing the economic return from the Northwest Shelf to very, very, very hungry fuel buyers around the world. But there are other names in the dividend space that make sense. And you don't have to get too risky with these things. As long as China continues to urbanize and consumes iron, even though right now they seem to be having a spat with regards to Australian iron, what they do is they buy Brazilian iron and Liberian iron, and then Australians sell the iron to the markets that Brazil and Liberia used to cover. So companies like Rio Tinto and BHP, big, stodgy, boring Australian super majors, they're generating the most cash relative to their enterprise value that they have in my 50-year career in investing. Will a recession hurt these companies? Absolutely. But if you're buying these companies for the 10 or 15-year time frame, even assuming that they fell in price in the interim by 30 or 40% while paying you 6 or 7 or 8% a year, when we go through this recession and the world comes to the reality that they have underinvested in basic commodities for 30 years, you will be treated very, very, very well. My favorite for most people are probably the gold stocks. They're my favorite because in my career, I have never seen gold stocks as cheap based on net present value relative to enterprise value at today's gold prices as they are right now. Often in my career, in fact, for most of my career, to justify the prices that one would pay for gold stocks, you had to account for higher gold prices. They priced an optionality. Around the world, people are sick of the optionality trade, so you get the upside for free. Normally, when you value gold stocks at current gold prices, you're valuing them at a premium to net present value, 1.6, 1.7 times net present value. And you're choking on that valuation because you know how explosive to the upside they can be if the gold price goes up. But you don't have to give the gold price any upside to justify some of the gold companies now. But in addition to that, I think we're at the place where it is likely, although not in the near term, that the gold price rises. The primary cause of gold price increases in my life, Karen, we tried to make this point at the conference ad nauseum. I think we did it.
You did.
Gold does well during times when people are concerned about the purchasing power of savings instruments denominated in foreign currency, or in, fiat currencies, particularly the US dollar. Do they have a reason to be afraid today? Well, I would suggest that the US 10-year Treasury paying 3.5% in a currency that's depreciating by 9% compounded would give any saver concern about the maintenance of their purchasing power. The US government absolutely, positively guarantees, for the first time in my life, they're going to make good on a guarantee, that they will steal 5% of your wealth a year for 10 years if you give them money now. My friend Jim Grant calls that return-free risk. Now, in the very near term, nominal interest rates, not real interest rates, but nominal interest rates are fairly strong. The US dollar is rocking. We can talk about why some other time.
Yeah.
And so the gold quote is weak. But believe me, I'm an American. The only reason that the US dollar is rocking is because every other currency in the world, unfortunately, including your own, sucks.
Yeah, that's exactly right. Milkshake theory.
The US dollar is the prettiest mare at the slaughterhouse. And I think people need to understand that. So you have a circumstance where the gold price discounts no increase, pardon me, the gold stocks discount no increase in the gold price. And I think we're knocking on the door of an increase in the gold price. And if you can afford to be riskier yet, the Australian penny dreadfuls, the sub 250 million market cap companies, they can't catch a bid.
Yeah, they can't. It's like walking through
There's no liquidity in the market. And Australia has treated me very well over the years when it's gone no bid. I remember, Carrie, relating to you going to Diggers and Dealers in 1991, I guess. And I think I was the only guy in Kalgoorlie that was willing to write a check.
Wow.
I know you'll find this hard to believe, but I attracted more attention than the skimpies. The fact that there was fresh blood on the floor, was so attractive. And that turned out to be one of the best conferences of my life. Buying into no bid markets causes you pain in the 12 to 18 month time frame and makes you fabulously wealthy in the 3 to 5 year time frame.
And I think that's important thing. And that's one of the things you brought up at the conference, Rick, was that people these days have got a very short attention span and therefore a very short investment time span. And what you said at the conference was you have to look longer than the sort of the in the front of your nose. You've got to look, like you just said, between 2 to 5 years and be patient.
Carrie, what we want, which is instant gratification, is irrelevant. We have to focus on what we can have.
Yeah.
Warren Buffett, a pretty good investor, said, among other things, that the market is a very efficient mechanism for transferring wealth from the inpatient to the patient. From my own viewpoint, I've been on Earth now almost 70 years. And it's odd that given the fact that I probably don't have much time left, I've become very much more patient than I was when I was 30.
Yeah.
The reason for that is I've lived through so many 5 year time frames that, first of all, I understand that an expectation that doesn't involve 5 years is fiction. But secondly, 5 years doesn't seem like a very long time to me now. I've been through 14 5-year time frames. And I'm competing against people who perhaps because they don't have any feeling about the value of stocks and hence have less conviction around the price. I'm competing with people who have trauma holding stock over a long weekend. And those people just can't compete with me.
So patience is really important. One of the things you said a moment ago was that you think that the gold price, and look, it's not all about the gold price, but what do you think is the catalyst? Because there's a few people out there at the moment that are saying it's not just recession, it's depression, and Armageddon's coming. Stay out of stocks, get into cash. Are you suggesting that actually that's possibly not going to happen, that there are certain areas where you will do very well?
I think that they're both probabilities worth considering. I certainly believe that you should hold lots of cash, lots of liquidity, despite the fact that those cash savings are depriving you of purchasing power. I mean, I get perfectly well that if you're holding 10% of your portfolio in cash, that you are losing 5% of the purchasing power compounded on that 10% per annum. I regard that negative savings as an option payment.
Right.
Having liquidity, if you go into a market period that's illiquid, is priceless. I remember very well 2009, the first liquidity crisis that I was both liquid and confident. And that was a fantastic year for me. Having cash in a liquidity crisis gives you the tools and perhaps the courage to take advantage of the circumstance as opposed to being taken advantage of by it. So, and I, by the way, personally regard my bullion as cash.
Absolutely.
Good cash and volatile cash. But when I look at my liquidity, I consider gold to be part of my liquidity because I can sell it in a nanosecond. I don't discount the fact that if we have an economic recession, an economic reckoning, if you will, that it could be a recessionary or depressionary type investing type circumstance. And in that case, at least initially, the gold price would go down too.
Mm.
But if you look back at past recessionary periods, in particular, the Great Depression, 1928 to 1936, gold held its value extremely well, precisely because people were concerned about the purchasing power of their savings in fiat instruments.
Yeah.
It doesn't matter as much recession or depression. What matters is a lack of trust in the system.
I'm just going to reach out to the girls. Does anyone have any questions? Because I'm sort of here, but this is your chance to ask Rick Rule a question. Looks like I might have one behind me. No? No?
So, Kerry, just
Yep.
in relation to renewables like your lithium.
If you can speak up,
Yeah.
you can speak directly.
Just in relation to your renewables, in us being a rich mineral country, and with some significant research into mining, well, lithium not so much, but some of the other minerals that go towards renewables. What's your thoughts there?
If I understood the question, there were two questions. One involves the broad subject of renewables, and the second question revolves around the implications for renewables construction in mining. Am I correct?
Yeah, and the product we're bringing out of the ground, and some of the new product that they're going to bring out that will replace the lithiums and things.
So what are you suggesting is
Is that because is that a worthwhile investment in going down that sort of more risque, like where they're looking for the stuff that can,
I suspect in the very near term, the lithium market is ahead of itself. The lithium price is up by 500%.
Yeah.
And the world is not short lithium. What the world is short is processing capacity.
Yeah, that's
to
correct.
turn various ores into lithium.
Yes.
In the lithium space, my suspicion is that you want to go with the biggest and the best and the very largest producers.
Yeah.
What attracts me in the so-called battery metal space, I mean, the biggest battery metal of all, which we forget a lot about, is copper.
Yep, Dr. Copper.
Copper is the stuff of humankind. But if you get below copper, sulfide nickel deposits, I'm less attracted to the lateritic nickel deposits, the Indonesian and the Philippine deposits that, don't confuse me with Greta Thunberg or anything like that, but they do so much environmental damage that even a jaded old pro like me says, don't do them. But the sulfide nickel deposits, the Kambalda style deposits in Australia, I think are going to become extraordinarily valuable. If you can find an ultramafic rock assemblage in Australia that, in addition to having nickel, might have cobalt in it, or better yet, cobalt and chrome, I think that you're going to see a great wave of exploration in Australia in terrains, ultramafic and mafic terrains that would have been considered nickel terrains in past epochs, and will now be considered, quote, battery metals.
Forward-looking futures, yeah.
And to the extent that you're successful finding those things, and you may very well be because you haven't looked for them before, I think those are going to be really tremendously valuable. When folks like us, let's just be candid, Caucasian people, fairly well-to-do, think about alternative energy, we think about things like Teslas. Yeah. And it's true that our future involves more gadgets and more electricity. But what's going to drive the electricity market is a wonderful, wonderful, wonderful thing. You need to tell your kids this. What's going to drive demand for battery metals is the ascent of humankind. We talked about this at the conference. 1.2 billion people on Earth don't have electricity. Don't think that these people are willing Luddites. They all want to live like you do. And in the last 30 years, more and more of them have. 2 billion people on Earth only have access to intermittent or unaffordable electricity. The electrification of humankind, the urbanization of Malawi, the urbanization of Indonesia, the urbanization of Bolivia, over the next 30 years will do the same thing that the urbanization of China did. And it isn't just going to be copper wires to houses. It's going to be light bulbs. It's going to be all the little goodies. I mean, can you imagine if you live in Congo on the equator, how much your life would be improved by having an air conditioner?
Yeah.
As an example. So when we talk about the effect of alternative energy schemes, battery schemes, all these gadgets, while it's tempting because we're all ethnocentric to think that we are the market, we aren't the market. We're only part of the market. The real market, if you look at the demand for Australian assets, the most important contributor to the boom of the mining industry in Australia in the last 30 years has been China. And we have 3 more Chinas on the runway.
Yeah, but there's a lot of focus at the moment, Rick, on China, and all, over here, a lot of people turning around saying, oh my goodness, Australia's going to fall off a cliff because of China. But
Yep.
we know that we don't have to just focus on China because, as you said, there's another 3 on the runway.
Well, you know, they have you by the nose and you have them by the nose. And, you know, hopefully nobody twists.
Mm.
Hopefully we learn that you have something they need and they have something called money that you need. And, you know, we trade it all peacefully and everything works out well. But it's important to note that, you know, India limps along, gets a little better every year. There's 1.3 billion of them.
Absolutely. Any other questions? That's all right. That's okay. We'll keep chatting for a moment. Rick, one of the things that we spoke about at the conference was, and if I just go back to my notes.
Good for you. Good for you. She's
gotta-
pandering to me now.
Of course, of course. Well, you know, it's evening there. One of the things that I think it was Mike Larson spoke about is Wall Street and the big corporations all feeding at the free market trough.
Right.
Do you think that anything is going to change with that as we go forward into this potentially much more inflationary environment? Do you think there'll become a reckoning for potentially big corporations and Wall Street?
I think there may. Wall Street is pretty good at dealing with changes in interest rates. What they're not good at dealing with is changes in credit quality. Because they don't get paid not to earn fees. And their lending standards in bull markets deteriorate. The other thing that really scares me personally about Wall Street, at least the banking sector on Wall Street, is the increasing complexity and size of the derivatives market.
Exactly.
The big banks, JP Morgan Chase, will tell you that although they have 50 or 60 trillion dollars of nominal derivatives exposure, that their real exposure is much less because they're offset longs against shorts. What they forget to tell you is that that assumes that the counterparties pay. If you have a $50 trillion notional liability against a $400 billion balance sheet, what you're suggesting is that you are smart enough to operate a big bank with a 0.4% equity slice. I believe that Jamie Dimon is substantially smarter than I am. I believe that the correct equity slice for my bank is 10%. He believes that the correct equity slice for his bank before derivatives exposure is 7%, and after derivatives exposure is 35 basis points, 1/3 of 1%.
Wow. Yeah, that's
Now that works until it doesn't.
yeah. Well, when
Jamie
does the
Dimon will
imbalance
say to his
happen?
shareholders, Jamie Dimon will say if worse comes to worse for his shareholders, he has a put because the Treasury will bail him out. And history has shown that that's likely correct. Treasury, unfortunately, will not bail Rick Rule out. But if you ask me what scares me, the decline in lending standards, the financialization of junk debt, which we'll go into in just a second, and derivatives. And we should talk about the financialization of junk debt. Junk debt is perhaps an American term for privately or publicly traded debt from non-investment grade issuers.
Yeah.
And there's been a huge, huge, huge global, but sadly, particularly US industry in junk debt. And what's happened, because it has very high yield in an environment where most investors are looking for yield. Investors who don't understand the risk associated with that yield have been piling into junk debt. And a lot of junk debt in the US market and also the British market is in exchange traded funds. These exchange traded funds are hugely liquid, but the assets they hold aren't liquid. And if we have a circumstance where ordinary investors get concerned about credit quality and they sell the shares of the ETF, and the ETF is forced to sell their underlying assets to redeem the ETF shares, they're trying to sell assets into a market that's ill-prepared to equip them. Kerry, when I was a young man in the last junk debt crisis we had in the US in 1982, we had a saying for illiquid junk bonds that you went to sell that were illiquid. You call your broker and say, sell my junk bond. He says, oh, that's an owl bond. An owl bond is when you call your broker to sell it and he goes, to-hoo. And that scares me. I mean, it really does scare me. I look at, as you know, I'm a credit guy by background, and I look at the covenants around these bonds, and the covenants were put in place by Wall Street to benefit the issuer, not the investor. That's all good until things go wrong. So all that scares me.
But so the growth in the ETF market has been absolutely enormous, as you just said. Investors are piling in. Yep. Does Rick Rule have a feeling that there's just a little smell out there, and could it be that black swan event where we wake up in the morning and suddenly, ouch, what's happened? Which means that the little person suffers.
I think the ETFs are wonderful vehicles in markets where the underlying assets are liquid, like an S&P 500 fund, a global large cap value fund. I think they're fantastic vehicles. You can own the global economy if you want to. You can buy 50 stocks with the click of a mouse.
Yeah.
And the fees are very, very, very low. So I like that. Products that are large liquid products that hold illiquid assets themselves are absolute value traps. And the people who buy them look at the liquidity of the asset they hold, the ETF, and they don't understand that that's sort of an envelope full of illiquid assets. And if they and some of their fellow shareholders go to sell simultaneously, there won't be a bid for the underlying assets. Yeah. And most investors that I talk to that own ETFs don't understand anything about the complexity of the market that ETFs cater to. I own a US ETF called the Dividend Aristocrats. It's a stodgy old thing. I don't like studying great big companies. I don't think that I can outcompete the guy from JP Morgan or Goldman Sachs. The Dividend Aristocrats consist of 50 companies that are all S&P 500 companies that have met or exceeded their dividend every quarter for 30 years.
Wow.
You know, the sort of Procter and Gamble's of the world. Okay. That's a perfect thing for an ETF. The last thing I want to do is do discounted net present value analysis on a toothpaste producer. You know, I don't want to do that. And the idea that I can buy the most stable financial companies in the world, 50 of them, with the click of a mouse.
With one instrument, yeah.
And I can pay a 20 basis points, 0.2% fee. I just love that. I absolutely love that. It saves me hours of tedium understanding the companies that are constituents. But a junk bond ETF, or for that matter, a penny mining ETF, Very
Danger.
different circumstance.
Danger, danger. All right, we've got to wrap it up in a minute, but one of the things that I wanted to, did you have one more? No. One of the things I want to say, right, if we go right back to the beginning, and one of the things you said, you talked about uranium, you talked about gold. Are those the two areas that Rick Rule feels has the most value in the current market?
Yes. Yeah, absolutely. I'm myself, because the junior sector has fallen in price so much, more attracted to the juniors. Carrie, for the last 3 years, when you and I have been talking, I've been sort of saying, forget most of the juniors. On a risk-adjusted basis, the value's with the seniors. But the juniors have fallen by 60 or 70 or 80%. And I'm starting to see real relative value in the junior space. I also, as a speculator, enjoy private placement investing.
Yeah.
And for the last 5 years, the placement terms have favored the issuer, not the check writer. That party's come to a screeching halt. And the terms are starting to favor the check writer. And given the fact that I'm a check writer, what I'm doing with my own money is much more speculative than what I'm suggesting my conference goers do with their money.